I think you need to be disciplined on making sure a deal's going to stack. The book at the last set of accounts we published was about £10 billion. 10 billion. So the bank has grown very, very quickly. As a lender, you'd always rather have more money to lend. You can do more deals, you can make more things happen. It might only be 20, 25 grand loans, which sounds tiny compared to a lot of the stuff that we work on now, but they were the most difficult loans to do because you've got no security. Do you think this person's business idea is good? Do you think they've got the skills to be able to make a run of it? And if it goes wrong, how are they going to pay the loan back? The person behaves with integrity, and that comes across from how they've managed the problem. That goes an awful long way to building trust with a lender, because we think, well, if you have an issue with us, you're going to act with integrity too, in which case we'll be able to figure it out.
Hi everybody, and welcome to another episode of Property People. Today I am thrilled to be joined by Mr. Daryl Norkett. How are you today, Daryl?
Yeah, very good, Sam. Pleasure to be on.
Good. Well, quick introduction. Daryl, you're head of real estate proposition at Shawbrook Bank, and it's your second stint at the bank, previously head of products and markets. Starting your career in 2013 at Barclays Bank, you have an incredibly profound insight and level of experience into the world of property finance from a lending perspective. I've always enjoyed every interaction with you. I think you are a fountain of knowledge with this stuff. So
very kind.
Thank you for joining us.
Cheers.
Before we get into all the stuff about lending and banks and finance and development and this, that, and the other, and all the wonderful things that we usually talk about when we're together, what I like to know mostly is, what kind of person were you at school?
Oh, that's interesting. So I did all right at school, actually. But the main thing I was in trouble for was talking too much. So generally, every kind of parent's even be, yeah, he's doing really well, you know, he's kind of engaging, he's got lots of friends and stuff, but God, he just talks too much, and sometimes it's a bit of a problem. So I remember at primary school in particular, it was, you know, circle time, reading time, and all the rest of it. And I didn't always do what I was needed to do, and perhaps listen as much as I should, preferring to kind of chat to people around me. And I think that it's probably carried on into my career, if I'm honest.
Very interesting. Actually, no, you are always, I always find you easy to talk to be fair. And some of the roles that you've had as kind of relationship director, I think you're very personable. Alongside your incredible technical knowledge, you do seem to build really good relationships and get on with people. People want to work with you.
Yeah, and you know, I think that's what property is all about. You know, people don't wake up one day and think, Christ, I really want to get a mortgage. They think, I really want to do a deal. How do I do it? So for me, it's all about, you know, understanding what makes people tick, why they want to do the deal, what they're trying to achieve. That's the really fun part of lending. The technical bits are all really important, but the reason I love the technical bits is because they help you do some really creative deals. If you didn't have that knowledge, perhaps you couldn't structure in a way that would protect a lender's risk ultimately. So yeah, it's all about people, what they're trying to achieve. You know, it's running and growing a business, essentially.
Absolutely. So at school, talkative, chatty, straight A's?
Do you know what? Later on, mostly, but not to start off with. So I would say I was academically a bit of a late flourisher. But yeah, by the end, please.
I was like bang average. I was getting C's, some above, some below. I was not very academic at school, but you're saying that you were actually a late flourisher.
I was. So by GCSE time, I was kind of there and there, not completely straight A's, but mostly. Basically, if I enjoy something, I tend to do quite well. Yeah. If I don't, I tend to do not quite so well. So my Achilles heel at school was French. I just didn't really get it, kind of got by with a C. At the time, really didn't like it. But I look back now and I think, crikey, I wish I'd actually engaged with that a bit more and learned a bit of French, because knowing a foreign language would be really useful once you grow up and you start travelling and you're going abroad and things. But yeah, and it was similar for me at university, actually. First year, partied too much, spent too much time with sort of lots of new friends that are still friends now. Didn't get the best grades in the world, but by the end was kind of doing really well, and ended up getting a first, which I was sort of super proud of at the time.
Wow,
so,
well done.
Yeah, I kind of get there in the end when I put my mind to it, I guess.
A first in what?
History.
Oh, very good. All bankers should have a degree in history.
Well, you say that. I've said this story a few times to different people. So everyone says that because you say, oh, I'm doing a history degree. What do you want to be, a librarian? Absolutely not. I don't want to be a librarian. I didn't really know what I wanted to be at that time either. I wasn't dreaming of being a banker either. But when you actually come into certainly kind of the property finance, commercial finance type world, a lot of the skills that you learn doing a history degree are actually very transferable, because history is not about learning what happened. That's kind of what you do at primary school, you know, in secondary school, dates and stuff like that. When you actually get into kind of degree level or even A-level history, it's about taking in lots of information, so lots of research, digesting lots of information, and then presenting that back to answer a question. And actually, that's the same as looking at a deal. You're taking lots of information, some of it's numbers, some of it's softer stuff from what people tell you, and you present that back to tell someone why they should say yes to that deal. It's actually very similar. So I always think that's put me in good stead.
So as a historian, I guess, yeah, it's more investigative, and you end up deciphering what is true, what isn't true, and then when you're looking at a deal, you're kind of almost doing the same thing, right?
And what you learn with history as well is that there isn't always a true, you know, in that you don't know. You've only got certain evidence to go on, and all of that evidence is generally skewed because everyone's got their own agenda at the time, and you're making a judgment based on kind of the weight of the evidence, I guess, which is very similar to lending, because every deal's got pros, every deal's got cons.
You're never going to know everything from the outset. You only can go on the data that you're given, then you make an educated guess to say, I think it's going to end up here.
Absolutely.
And that's how you do it. It's very interesting, actually. I never even thought of history. And you know, they talk about, like, those that conquer the world, they write the history books. So that actually, as a historian, your job is to probably go back and say, right, is that accurate? Who's written that? What was their agenda? And you're doing exactly the same process when it comes to looking at a valuation report, looking at an estate agent's appraisal versus a Rick's Valuer's appraisal, etc.
Yeah, absolutely. And most history books actually are almost about the same thing, but someone will come along and sort of say, well, actually, that established logic on why World War II happened isn't quite right if you look at it like this, and you look at it from this person's perspective, or you look at the diaries of this, you know, of this prime minister or whatever it might be, or this MP. So, yeah, absolutely. I think those skills do transfer across to probably quite a lot of job roles, and actually quite a lot of history students end up as lawyers and do law conversion courses for a similar reason.
That totally makes sense. And now that you got a first, so you must have enjoyed it.
I did, yeah. I loved it. It's kind of, university was an amazing time, kind of work hard, play hard, and built friends for life.
Which uni?
University of East Anglia in Norwich.
Very nice. Yeah. And so from there, getting a first, enjoying that, having a great time, the first foray into the world of work, was it at Barclays?
Yeah, it was. So it came about completely organically. I was working for Vodafone at the time, actually. It was kind of a job I did whilst I was doing my master's degree. And I got a call from a recruiter one day saying, Barclays are hiring in Norwich. You're in Norwich. Are you interested? Thought, sounds interesting. So went down for the interview, got the role, and joined the business bank. So I was working with small businesses, essentially, you know, kind of cafes and small restaurants, that sort of stuff. Really enjoyed it. Sort of made a bit of a name for myself up there doing sort of smallish, really, but unsecured loans to startups quite often. So it might only be 20, 25 grand loans, which sounds tiny compared to a lot of the stuff that we work on now. But they were the most difficult loans to do because you've got no security, you've got no financials to rely on. It's just, do you think this person's business idea is good? Do you think they've got the skills to be able to make a run of it? And if it goes wrong, how are they going to pay the loan back? It's very similar to looking at the bigger stuff, but I always felt harder because you didn't have the benefit of that collateral sitting behind the loan.
So it was literally just off a business plan?
Yeah, generally. I mean, someone's personal covenant had a big impact. I would say, if I look back now, kind of knowing what I know now, at the time I probably thought that the business idea and the plans mattered more, but actually I think someone's personal covenant probably matters more.
When you say personal covenant, what does that specifically mean for anybody that doesn't know?
Their access to liquidity. So if their business idea doesn't work, because with the best will in the world as a lender, you never really know. It's a bit of a judgment. There's quite a lot of risk with starting up a new business. How could they pay that loan back? So for a lot of people, they might have personal wealth in the background, other income sources, other assets and things like that.
Might have a expensive car that they can sell, liquidate, and then dog or something.
Absolutely, yeah.
The business plan, when you're looking at it, Do you help them create it? Do you kind of give them a template saying fill out these forms so we want to be able to see and what projections, or was it just kind of like how much were you mentoring these, or was it just applications coming in?
Yeah, it wasn't. It wasn't. It's not a high volume business in the kind of business parts of the high street banks. You do get a lot of time to spend with the client to kind of help them share ideas, talk to them about all of their plans in quite a lot of detail. So it's fairly in depth, fairly sort of thorough. And obviously, the guys that went on and had successful businesses, you'd speak to multiple times during the year, as you're kind of catching up and seeing what else they might need as they go along the journey. But yeah, ultimately they wrote the business plans. It's always the business owners and the people that make things happen, not the lenders. But it's great to get involved and to see some of those businesses and how their experiences were, kind of starting up from scratch.
And was there any at that time businesses that were off the table that were like, sorry, if you come with a laundrette idea, for example, we're just not touching it? Did you ever was there any parameters of businesses that you wouldn't go near?
That's a really good question. I'm trying to think back now because I'm sure there were. There was different appetites. So at Barclays at the time, there was different appetites for different sectors. So every sector had a set of lending guidelines and policies that supported it. So you might be less aggressive with retail than you might be with a manufacturer and these sorts of things. There wasn't really much that was complete no-go, if I'm honest. But there were certain areas where appetite was very limited. And actually, ironically, given how my career progressed post-Barclays, property was the main one where appetite was very, very limited at the time.
Oh, really? It was limited at the time?
Very limited. I mean, I started in Barclays in 2009, so literally, right, straight out of the credit crunch where, their massive balance sheet of property deals that, perhaps has caused their fair share of challenges over the couple of years prior.
So there was probably still hurting and therefore a bit shy on that side and thought business is probably a better way to get in the market. And you're saying the average ticket size was 25,000, or that was the max or the minimum?
Yeah, in that role. And then I kind of progressed up the ranks at Barclays working with sort of slightly bigger businesses until I got up to kind of the first level of the corporate bank. And then you could be dealing with kind of anything up to $1 million, maybe a couple of million a debt sometimes. But it just sort of scaled over time with the size and complexity of the businesses.
So again, it's quite fascinating because you've got this history degree where you're doing all this investigative stuff, and then you're getting into business plans, trying to find out whether somebody's going to be good for it in terms of delivering a business plan, being able to repay it, and then working on slightly larger stuff. So when did the property or the kind of the Shawbrook come on the map? How did that all happen?
So again, that was completely organically. So I joined Shawbrook originally in 2015, and there's a particular broker I had a great relationship at Barclays, and had done a few deals with him, and I thought we were doing loads for him. This is amazing, and he suggested me to Shawbrook. Had the opportunity to go along for an interview. Someone who was running the region that I was in, so I live over in Essex, so kind of east of England way, had just left. So complete organic opportunity that came up. Went for an interview, really liked the sound of it. I was also really happy at Barclays, if I'm honest. I wasn't someone who kind of left the high street banks because it's too bureaucratic and you can't get things done, because I found you could get things done. But I was just excited to go into something that was completely new and would kind of broaden my overall knowledge of the finance market. And, looking back now, it was quite a tough decision at the time, but it was a great decision for me, because when you step out of the big bank, there's this enormous world of specialist finance that you've very little awareness of actually in a big high street bank, but it's actually where a lot of the exciting stuff happens.
Yeah, I mean, talking about excitement, I mean, you were quite early in Shawbrook Bank. You were one of the earlier members. When was Shawbrook Bank formally formed?
So 2011.
2011. So you came in at 2015.
Yeah.
It's definitely in the
fairly early
years.
Yeah.
And you've seen it grown quite significantly since then. And they refer to banks like Shawbrook, and there's quite a few of them that have grown as challenger banks. So what's the definition? What's your understanding of a challenger bank and the difference between a challenger bank and a high street bank?
So I think the challenger bank label came from the mainstream press as a way of describing a new wave of banks that are set up post-crash to challenge, to take on the high street banks. But I actually think that name's not really representative of what happened in our sector. So perhaps if you look at Metro, who've got branches and a more high street bank style business model, you might use that label of challenger bank. But I think certainly with banks like Shawbrook and other peers of ours that set up at the same time, we're never there to take on the high street banks. We're still not there to take on the high street banks. Now, we're there to serve underserved markets where there's niches that the high street banks don't get to or can't get to, or are too difficult or too complex, or they no longer have the expertise to serve. So for me, Shawbrook's not about taking on a bigger bank. It's not about becoming a bigger bank. It's about building something in its own right that serves specialist parts of the market in a very expert relationship-led way.
Interesting. So why isn't it the branches is not part of certain challenger bank strategy, like Shawbrook? What is it about high street banks that Metro think that's valuable that many don't? I mean, because Shawbrook, for many people, they if they're not in the specialist market, they might never heard of them. But if you're in the specialist market, actually Shawbrook's one of the biggest names.
Yeah, absolutely. I mean, I think the brand has grown over time. So I remember going even to property networking events back kind of 2015 time, and you'd sort of ask the room who's heard of Shawbrook, and even then you might get a third of the room put their hands up. If you walk into a property networking event now and you ask that question, you get 100% hands up, right? So the brand has grown over time. Our consumer awareness comes from the consumer-facing part of the business, which is a really important part of Shawbrook, but it's very targeted. So there's some lending that goes on, personal loans and things like this, but actually the savings business is what brings in all of the liquidity that funds all of our property loans and every other sort of loan that we do. So if you go on Money Savings Expert, if you watch the Martin Lewis show in the week or read his emails or whatever, we come up actually quite a lot in that world because we're going after people looking for savings accounts and encouraging them to come and deposit their money with Shawbrook. So it's targeted and it's about talking to our audiences rather than talking to everyone.
And that, I guess, is the reason why maybe a high street presence is not, and the overhead that comes with it is not really necessary, because Shawbrook's found a way to target their consumer in other ways, and which has been quite effective. Like I said, in this day and age, everybody go to a commercial or investment style and networking event, and everybody's heard of Shawbrook. So they're obviously doing something right, but it is it always fascinates me why Metro Bank decided to go down that route and not many others. Because there are quite a few challenger banks.
Yeah, and there's a new wave now, actually. You look at banks like Starling and Monzo, for example, where they've gone down the current account route rather than the retail deposit savings strategy. But they've done that in a non-branch-based digital offering kind of way. The incentive of that is that you can just build a big customer base very quickly because everyone needs a current account. So your sort of addressable market then is very, very broad. So I can understand as a kind of mass market proposition why you might be tempted to go down that sort of business model. But where you're serving very specialist markets, I think it's about talking to your audience.
Absolutely. And your audience from the savers, and that's how any bank, most banks get their money in. They encourage savers to come in, deposit their money with them, and then they use that money to be able to go out into the market and make more money. Is that a fairly accurate way of putting
Absolutely.
it?
Yeah.
And Shawbrook's ways of making more money with that money. Give us a rundown of what those sorts of things are.
Yeah, so I mentioned we've got a consumer business, so we do some personal lending. We do some funding of kind of purchases and things, products and things like that for consumers. We've then got the enterprise division, which is the part of the bank that we sit in as real estate. And enterprise is quite broad. We've got lots of different markets that we participate in. So we've got an SME lending business that funds lots of assets, so things like cars, lorries, vans, kind of all sorts of assets, and a more varied pool than just that. We've got a development finance arm, so funding ground-up developments for mostly house builders. We've got a healthcare team. We've got a structured finance team that supports some other lenders get started with funding lines and things like this. And then we've got real estate, which is several markets for us. We have second charge mortgages for homeowners looking to raise more capital on their residential home. We've got buy-to-let, and for us, we participate in a very broad part of the buy-to-let market. Every single day we'll see a small kind of standard £100,000 mortgage on a house somewhere that's been let out, all the way up to £20-25 million portfolio loans and quite structured facilities that support that. We've got a commercial mortgages business, which has been super successful over the years, funding a mixture of fully commercial properties, different asset classes, as well as a lot of mixed use stuff. So we've always done a lot of mixed use properties as those buy-to-let landlords diversify into high yielding assets essentially, which semi-commercial often is. And we've got a bridging business.
So there's quite a few different pockets of capital spread across a lot of the specialist property sectors. And you mentioned healthcare. What is that specifically like?
Yeah, so our healthcare team will look at things like care homes. That might look at pharmacy and things. Anything with kind of a healthcare lens is a small team of people who've been in that sector for a long time.
And that's for like business and operational business codes.
Yeah,
got it. Okay, so then the loan book in terms of size, give like how big is it? How big has it grown since you've been there?
Yeah, well, obviously it started from scratch, literally from scratch. And the book at the last set of accounts we published was about £10 billion. 10 billion. So the bank has grown very, very quickly. And that's over kind of a 10, 12-year period to get to that level. So it's been enormously successful.
Yeah, that is quite a significant level of growth in a relatively short space of time. I mean, it's fair to say from the outside looking in anyway, Shawbrook is certainly one of the more successful new banks that have hit the marketplace. And with all of the different subsectors that you've mentioned, is there a specific favourite that you've got? Do you prefer buy-to-let? Do you prefer the commercial term loan? Do you prefer the bridging or the development?
Do you know what? I really don't. I just like the creative deals. So the ones that I really enjoy, and it doesn't matter what the right product solution is, it's just the ones where people are trying to do something a little bit different, perhaps kind of trying to forge a new strategy or solve a problem in a different way, where there's some kind of creative elements to it. They're always the really fun ones to look at and see if you can make work. And I think they're the ones where you can add the most value, actually, if you can find a solution.
Can you give us a couple of examples of like those sorts of deals that you've been working on recently that you feel that's actually it's been challenging but fun at the same time, and it's great to see the smile on the investor's face by the end of it?
Yeah, well, we had a very large deal that we did before Christmas, commercial property deal where we had a very large kind of office building that was broken up into lots of sub-units and then hot desking space, and it was very much kind of a modern, more flexible working type of structure and setup of the asset, as opposed to the traditional, box a building out and then let one floor to one company for 5 years and another company for 10 years.
Co-working spaces, kind of like WeWork, that sort of thing?
Yeah, it's kind of like that, but a bit more targeted at people in more kind of sort of artistic sort of sectors and spaces. Yeah, rather than just sort of desks and just sort of office spaces. So that was a really great one because the guys who kind of did that deal behind it had very clear vision, very clear strategy. Were able to articulate how it worked, where the market was going to be for it, how the numbers were going to look, how they kind of de-risked the deal for themselves, because you've got a lot of turnover of tenants, you haven't got much commitment from those tenants really. And we got there on it actually, and that was a great deal to see complete.
And what about development loans? Do you get involved in one side of the, because your current role is the head of real estate proposition, and previously it was products and markets. So, I assume that you're looking at where the opportunities are and then creating and formulating a whole product around that. And when it comes to finance, I mean, people think about products, they think about microphones and cups and mobile phones. The concept of something financial being a product, are you the one that comes up with the concept and that sort of thing? How does that work? What is your role in?
Yeah, so look, we've got a great team at Shawbrook, lots of people, lots of ideas, and we certainly in real estate, pretty much all of our business comes through the broker network. And the great thing about working with brokers is they're not short of ideas. They're talking to people every day. They're seeing what's difficult to get finance for, what's not difficult to get finance for, what are the new strategies that investors might be pursuing. So you kind of get all of that early access by working with brokers. So lots of ideas get fed in from lots of different places, and then in my role and the team that works with me role is really to take some of those ideas and figure out, can we build a financial product around that? Can we change a product we've already got to cater for that scenario? So it's always about trying to find the balance of the opportunity, what does the investor need? Can we do it in a way where we can price it competitively that's going to work and it's going to enable us to actually write business on these loans? Can we get the risk right? Can we get the criteria right so that it fits and that it doesn't stop people from doing the business model that they want to do? Pulling all of that together and then bringing it out to market. So that gives you the opportunity to just look at all different parts of the bank and so many different things that are going on. And then, me being a deals guy, I just am. I don't like staying too far away from it. I do a bit of kind of extracurricular activity, sitting on kind of some of our deal forums and things like that to get a bit of a sense of what's actually going on the ground and some of the opportunities we've got across our desks.
So one of these products, somebody comes to you with a problem or something that needs to be funded. When it comes to criteria and managing risk, what sort of things are you looking for to be able to create that product?
Yeah, it all depends on what it needs. So, we've got, like all banks, we've got policies in the background. What is acceptable and what isn't acceptable. That could be very kind of blunt things like loan to value. But there's also a lot of softer things around what sort of lease is acceptable in a commercial property deal, what sort of tenant profile is acceptable on a buy-to-let deal. And so sometimes it's about looking at the detail and what tweaks can we make to make a certain business model work, essentially, so that we get something that the investor's going to want, but that also keeps the bank safe at the same time.
So typically it's going to be LTV. Because once upon a time there was a broker. It was quite well to do. Did a lot of stuff around prime central London, and he told me, I think it was shortly after 2008, and he told me, Sam, there's always money available. It's only the price and the LTV that's different. So don't worry about it. If you want money, I can find it for you.
Yeah,
this might not be what you thought it was going to cost you or how much you can borrow. And those are the two main levers that you're kind of like pulling and pushing to try and get something done.
Yeah, I mean, there's an element of product innovation and product structure that can open opportunities. So on our bridging proposition, for example, we've got a great product called Lending for Costs. So it's a bridging product for light refurbishment deals. So usually landlords coming in to do a very quick, maybe a new kitchen, redecorate, get it let out. So very simple projects. But they're great for us because they're also the same clients that probably want to move on to a buy-to-let mortgage, which is wonderful. So we retain a lot of those clients with us. But we're typically at 75% loan to value on the bridge, which is where most of the market has. But by kind of doing some of that business and seeing that actually these guys, they're not spending huge amounts of money on these projects. They're actually completing the works usually within kind of a couple of months because it's really quite simple. Yeah. And then they're often getting the benefit of the increase in the value and sticking with us on the mortgage. We stretched to 85% for them. So that was more about product structure to open up that avenue to do something different that other people weren't doing in the market, and particularly suits our client base and our proposition. Other times, it does come down to how much risk are you prepared to take and where do you want to kind of price for it, and trying to get the balance right between those two things.
Interesting. I like the sound of that kind of product as well. I know two other lenders that are doing something similar to that. And it does work really well, and it takes somebody to see a gap in the market. It takes somebody to be able to understand how to manage that risk, because ultimately you're giving a lot more leverage than anybody else. But you can see that actually these people are reliable. They're going to add they're going to put their own money into it to add a little bit more value. So your overall LTV will come down, and it might help them minimize their equity overall. And then you can work on much bigger stuff as well. So, because maybe that, like I said, they go to a buy-to-let, maybe they start doing bigger deals because you've got that relationship with them. And that's, I guess, how you grow the loan book in the way that you guys have done it. Along your career, you did do a stint with another lending business as well. So it's not all kind of like, because life always goes up and down and round and round and goes different ways. How was that for you in terms of when things don't go right personally? How do you overcome what's the word I'm looking for? Things that get disjointed or things that don't quite go your way. Like adversity is the word I'm looking for.
Yeah, I mean, look, I'm very much a glass half full person. So
I vouch for that. Yes. Exactly.
Yeah. So none of these things, they just don't. I just don't let things bother me too much. There's always a solution. There's always, something else that you could do or another way around it. All that matters to me is that you do things with integrity, you give things your all, and if you do that, you've maximised your opportunity. Now, sometimes maximising your opportunity is not enough, but most of the time it will be, and you'll kind of land on your feet. But yeah, that was a non-bank lender called Lendwell. That I was at for a couple of 2.5 years, sort of in between 2 stints at Shawbrook, and that came about again as an organic opportunity with Shawbrook people. There's some of the people who were originally part of the kind of founding team at Shawbrook who had left over time, set Lendwell up, and I was attracted to the idea of trying to start something from scratch, ultimately, and also being in a non-bank part of the market to broaden my own experience. Because having worked at Barclays and Shawbrook, I'd always been inside a bank, 2 very different banks, but still a bank. And that was a great experience. We did some really creative, really interesting deals, and we had some very happy clients and very happy brokers. Come to a close early, but I look back now and I just think, what a great time.
Yeah.
We did it over lockdown, we did it over the pandemic. I'm very proud of everything we achieved, proud of what I learned, and it's enabled me to kind of come back to Shawbrook with the benefit of all that additional experience.
Yeah, overall, that I think you did really well with that as well, because like you said, everybody walked away, with only good things to say, I think, in general. So but then obviously, you're going a million miles in one direction. You probably have big aspirations, and then something comes along and it kind of turns you. And it kind of brings me back to deals in general. Obviously, I work on the brokerage side, and we've got expectations from clients, from borrowers who want to get their deal done. So they're going a million miles an hour in one direction. They're trying to get their deal done, and then at some point there's a hurdle that comes along, and for some reason or another, on a worst case scenario, the deal doesn't go ahead. On a best case scenario, it just gets delayed a little bit, or the terms might change slightly. So I'm constantly asking developers, kind of, how do you overcome all of that? How do you lose sleep at night? How do you deal with anxiety and all these things and manage your expectations? But at the same time, I've been on the lending side, and I know that lenders are on that road as well. You're not really going to get your revenue, you're not going to get paid for it until that loan completes. So you're kind of in the same boat. I think sometimes there's a complete disconnect where lenders and developers or borrowers, they feel like, they're a necessary evil, but actually for me, there's a symbiotic relationship there. And sometimes the pain must be on both sides. How do you, in terms of the number of loans that you do, because you probably do, if you've got a £10 billion loan book, as a bank, you're doing an incredible amount. Do you know how many loans that get applied for that don't go through? Do you have kind of an idea of what that looks like?
Yeah, we're tracking all that stuff all of the time, because every loan that we spend time on that doesn't progress is a cost, ultimately, that we need to cover. So, and also, it's just a bad journey. No one applies for a loan not wanting it. So it's all about getting as sharp as you can on the initial decision making, because the initial decision making is probably the key moment in time where you need to be really clear about what each party's trying to achieve, and that there's a good fit there. Later on, you sometimes get issues with valuations, you sometimes get issues with legals. Most of the time, they're not predictable. It wouldn't be fair to expect the developer or the investor to be able to know what's coming. Occasionally, there's things that happen that perhaps they should have known about, but most of the time they don't. So that's just part and parcel of the property business, and it's the same, for the agents and everyone else involved when they think they've got a sale. But for us, we spent a lot of time focusing on making sure that initial decisioning is quick, easy, efficient, but also very, very solid. And one of the things that everyone at Shawbrook is sort of very proud of is we've always acted with integrity, and we've always stuck by our promises. When we showed that by honouring the pricing we had in the pipeline during all the interest rate volatility that we've just seen. So conversion rates are pretty good. Could always be better. There's always things you can improve, but we're operating in a place now where they're materially better than they were kind of 4 or 5 years ago.
Yeah, I think, you have to have this stoic, because you're working on such a volume that eventually some of them are going to go through, some of them aren't. And then, like you said, there's little policies that you can do along the way to try and make those relationships a little bit less stressed by taking, I assume, did you guys take a hit when the mini budget, when the rates start going up? Were you getting squeezed, or how does that work?
Well, we're retail deposit funded. So, all the increases in interest rates fed through to the savings market, which therefore fed through to us. So yeah, cost of funds has materially increased. Yeah. And it's not just the fact that it's increased, actually. It was the pace at which it happened, and the volatility around it. You've only kind of got to Google the 5-year swap rate and go back and have a look. It's kind of very sharp movements when historically it's not moved too quickly and by too much. So that was an enormous challenge for us to kind of respond and deal with. We did more pricing changes on product between, kind of September and November than we'd probably done for the entire history of Shawbrook before then. But we made that process really slick. We were able to execute really quickly. We kept the doors open. All the loans we agreed to do were sustainable for us, which meant that the borrower had the commitment of the interest rate being there. We were super busy. So if anyone's kind of listened to the podcast and had deals in with us over that period of time, we were much slower than we'd like to be, and we were much slower than we normally are. We just had an enormous pipeline to work through.
I think every single lender in the land was going through something similar, and that they were just absolutely inundated. Yeah. Especially in the run-up to when interest rates, everybody knew they were going up. They were just even paying early repayment charges, saying, I just want to do my loan now. So you kind of manage your workload, but that workload just gets accelerated all into one confined short spurt. I think, it was excruciating, because some loans that should take 6 to 8 weeks were taking up to 16 weeks and more. This episode is sponsored by the PLMD Group. PLMD Group is made up of the PLMD Development, PLMD Estate Management, and PLMD Capital, providing expertise in real estate development combined with asset management. With more than 70 build-to-rent properties and £20 million of assets under management, PLMD's extensive knowledge of local planning policies have resulted in a strong track record, turning liabilities into valuable assets. The group delivers value through a fusion of experience, innovative design, imagination, hands-on management, and sustainable resources. To find out more about PLMD and the services they offer, head to plmdgroup.co.uk. With this new environment of higher interest rates, banks typically have, no one's been encouraged to put their money in a bank because the interest rates have been so low. I'm sure that the people that have parked money in there, even with the low interest rates. But now that's looking a lot more attractive, albeit right now it's slightly lower than it's lower than inflation, but that won't last for long. Do you think that the loan book of Shawbrook and every other bank will start to grow because they're going to have access to a lot more funds, because people are going to be depositing a lot more, therefore you're going to have a lot more to play with? Do you think that's on the horizon?
So I think for a lot of the specialist banks in our space, access to liquidity has not really ever been an issue. There's an enormous amount of cash out in the savings market in the UK, and there's an enormous amount of cash that's still sitting in current accounts earning zero interest, even now, when you can kind of get 4% pretty easily on the savings market. So access to cash has never really been the issue. Obviously, how much you need to pay for it impacts on how much you need to charge your customer to borrow money. Yeah. I'd say that's where the biggest disruption and kind of repositioning is going on. So we work really hard to try and keep pricing as low as we can. We did a huge rate reduction a couple of weeks ago that has been super successful in terms of new deal flow we started to see over the last couple of weeks, which is kind of great. Suggests there's still market activity out there and people are still trying to do stuff. But for an investor, it just depends so much on your business model. If you're out there doing co-living, HMOs, high mortgages aren't welcome, right? It's another cost in your business, but it's not, it's a relatively palatable cost. And actually, the rental inflation you've seen through the market has kind of balanced some of it out, and they're high yielding properties. There's a good return in them anyway. That business model still looks really strong. If you were doing, I don't think we've seen too much of this as new stock for a while, but there's certainly a lot of old stock out there. But if you were looking to refinance, a lovely leafy semi-detached 3-bed property in Richmond or something like that on a really skinny yield where house prices have been rocketing up, and you look at the cost of your mortgage, it's not going to be as good, on a profit and loss basis for the investor. So we're going through a period of adjustment in the market. We're not seeing a big exodus. So some landlords will inevitably choose to leave the market in a higher interest rate environment. Others will choose to come in because they see an opportunity to buy. And buying property has been very difficult for the past couple of years. We've had kind of a bit of a COVID pandemic kind of induced bubble. So things will adapt, things will change, rents will go up, property values, thankfully, touch wood, look pretty stable, but we expect them to come down a bit during this year, and kind of yields will stabilise. So it will adjust, but it takes time. Property doesn't move that quickly.
Yeah. So there's always a bit of a time lag, and then the equilibrium will be found maybe 3 to 6, 12 months even from now. And I was actually having a conversation with somebody earlier about this. I think my personal opinion is that right now, due to all this volatility in the market, and it's not just interest rates going up, it's there's inflation as well, and that's some of it's supply side as well. It's not necessarily all just about how much liquidity is in the market from all this money that was injected due to COVID, etc. But that inflation with those higher interest rates, I think that there's possibly quite a lot of distress that is happening. It doesn't have to be coming to the surface and going to the news, albeit we've had Citigroup and SVB Bank recently. I just think it's one of the better times, if not the best time, since 2008 to be looking for property deals and that sort of thing. You speak to investors and developers, I imagine, regularly, and your own sentiment. What do you think? Do you think that now's a good time to be looking to buy, or would you just be kind of consolidating right now and holding back?
I think you need to be disciplined on making sure a deal is going to stack. So, I think there's a temptation in a tougher market to maybe kind of use an optimistic number over here or one over here because you kind of want to do the deal and you want to make activity happen. So I think you need to be disciplined to make a deal stack. But I think this is a better time to be buying and expanding your portfolio than probably what it has been for the last couple of years, just simply down to the fact that you've got less competition. And the residential market for buy-to-let in particular, on the owner-occupier side, has been super, super busy. Lots more transactions per year than we'd normally see. And as an investor, it's actually really hard to compete with those guys because an owner-occupier will buy a house because they want to live there. They see the lifestyle, perhaps it's near the right school. And for an investor more focused on the numbers, sometimes you just can't compete with that. But as that market inevitably kind of quiets down a little bit this year with the affordability challenges and things in the kind of mainstream mortgage market and the adjustment period that also needs, that will mean that I think investors can get back out there. You can negotiate on the price again. You can try and do a deal and you can try and make it work for you. And you've got the benefit now that you kind of know where interest rates are. Now, I haven't got a crystal ball. They might change again. But you know where they are today. So we've kind of had the rapid correction of rates that we've all expected to happen at some point in time. So you kind of know where you are. So if you can make it stack today, you can make it work, you can come up with a strategy where it's going to be profitable today, you should put yourself in really good stead for the future.
And so, I mean, and when people are looking for deals, I know there's a lot of people that are very hungry to do stuff, but they're nervous and they think that when there's disruption, that's when they should become greedy, or whatever the quote goes. A few macro kind of metrics in the marketplace that you can look at is in Bank of England base rate, which just went up to 4.25 yesterday, and then swap rates. Can you tell us what the relationship with one another is, or how one of them that goes up doesn't necessarily mean the other one goes up, and kind of the definitions of these two things and the relationship?
Yeah, so in very, very simple terms, the swap rate is the average cost of money, or what the market thinks will be the average cost of money. So it may not be true, but what the market thinks at the moment over a period of time. So the 5-year swap rate gets a particular amount of attention because most investors now take 5-year fixed mortgages. So that swap rate at the moment is kind of about 3.7-ish. What that's sort of saying is, as an average over 5 years, we think that the risk-free cost of money is 3.7. As a lender, therefore, if you take that and you're looking to kind of price product and you sort of accept that as a baseline, then you need a margin on top of that, which is why we see mortgage rates kind of in the high 5s and 6s at the moment, because there needs to be a margin there. But it's only the market's prediction. It can change, and it's changed a lot. Just since kind of post mini budget, when things settle down again, kind of when Sunak came in as Prime Minister, we've had that 5-year swap go as low as about 3.2. We've had it go back up above 4. Even in February, we've had those kind of highs and swings. It's still quite volatile.
In the last few months, it just goes up and down like a yo-yo.
Still, it's nowhere near as volatile as it was in October, so we kind of got used to it. But it's still, in historical standards, it's very volatile still at the moment. But it seems to be finding its norm at something around 3.5, right? Around 3.5 seems to be where it's finding its norm. Bank of England base rate is in theory the cost of money today, the risk-free cost of money today. So if the swap rate is lower, that's the market suggesting that Bank of England base rate will come down over that period of time. So I think the expectation is that base rate will remain where it is. Maybe they'll put it up again a little bit, maybe they won't, but I don't think we're expecting it to kind of rocket up too much higher. But it will remain there for as long as it takes, I suspect, to get inflation down, which hopefully will be this year. Some of the forecasts are suggesting we'll be back down to 4% by the end of the year. But we were all surprised with the news the other day that inflation had gone up. So there's lots of variables at play. No one has a crystal ball. No one really knows. There's no kind of magic thing that when you're inside a bank, you kind of got all this special information that no one else has.
Oh, Daryl, so disappointing.
We're all making our own judgments, right? But my personal read on it is if you sort of accept that buy-to-let mortgage at the moment is around 5.5, 6-ish as a baseline, that's quite a solid baseline for the time being.
Yeah. No, that totally makes sense, and I think that's a really, really good explanation as well. Because I think some of these terms sometimes bamboozles people, and it makes it really hard to understand. Are we going up or down or round? If this one's going up, why is this one going down? But I think that's a really good explanation. Now, in terms of the people that you work with, clients, borrowers, in terms of their size and stature, kind of who do you find yourself interacting with the most at Shawbrook Bank and yourself personally?
Yeah, so we've got a very broad client base now because of the size of the business and the size of the book. So we see some very experienced guys operating at a very good level, doing kind of pretty chunky deals. We go up to kind of 35, 40 million pounds exposure, so it's pretty big. We don't have loads of clients up at that level, but we do a lot in the kind of 5 to 15 range all of the time. Sometimes that's people who operate in that world day to day. So we might see an individual big loan come in on a really big property, maybe a big block of flats, big commercial, whatever it might be. But sometimes it's people who've built their property businesses over time. And I'd say traditionally, a lot of our success has come from supporting people who are hungry to grow. So we were early in supporting HMOs. We were early in considering an investment valuation on a proper kind of investment grade HMO, things like that have facilitated people to build their business over time. And a lot of the bigger customers we have might not necessarily have one very large loan, but they've actually done lots of loans over a long period of time and built up a large business and a large exposure with us. So, real mix of people. But we're in the more professional end of the market. I think that doesn't always mean, Shawbrook customers not always got kind of like 20 properties in their portfolio. Sometimes they got one. Yeah. But I do think we probably appeal the most to those people who think about property as a business, who want to be in property and are fairly committed to trying to grow their place in that market.
So these are typically more active, prolific, somewhere in that phase, rather than your one-off here and there. That's you kind of very much for catering for those kind of more established investors and developers, or certainly growing as well.
Yeah, and I say we see a few first-time landlords from time to time, but most of our client base is professional. They're hungry. They're looking to grow. They borrow in limited company. That's a really big change over the last kind of 5 years or so. The vast majority borrow in limited company now. Not all still, but most.
When you have a borrower that wants to apply for a loan to a bank, Shawbrook Bank, what sort of things are you looking for them to have? Like, what are you looking to see in terms of their application? What are red herrings that you don't want to see, and what are the things that you like to see that make it easier to say, yes, let's do that?
Yeah, I think the overriding principle is we just want to have confidence that that particular investor can deliver that project or manage that asset. So we look at experience quite closely, but experience relative to the complexity of what you're proposing to do. So, you know, buy-to-let landlord might be transitioning into HMOs or something like that and taking those sort of steps along the journey. We've always been very supportive of that. We've seen lots of more established buy-to-let landlords branch out into semi-commercial properties, for example. What makes you more nervous is when someone's kind of going in at the deep end. So, you know, kind of new to property, but going in with a really complicated 18-bed HMO or something like that. That's always a bit harder because there's obviously the learning curve just that bit tougher. So you kind of feel like the probability of there being some bumps along the road are higher. But yeah, people who are kind of trying to build out gradually, step by step, we're always super supportive of.
So, what about things like adverse credit, or I've got I don't know, I had a rent business, and then in COVID, all the people that were living there went back to where countries that they were from, and they left me high and dry, and I had to pay the landlord, and then I had to wind it up.
So it depends for us. We've got an open mind, right? So we're not a lender that has carved a niche in sort of specifically serving people with lots of adverse credit. That's never been the kind of Shawbrook pitch. It's more been about the professional property investor. That said, stuff happens along the way for people. So we look at it deal by deal ultimately. What is the extent of the adverse credit? Are there still financial liabilities out there or not? How big are they? How did the person behave? So if a person behaves with integrity and that comes across from how they've managed a problem, that goes an awful long way to building trust with a lender, because we think, well, if you have an issue with us, you're going to act with integrity too, in which case we'll be able to figure it out and it'll be okay. So all of that makes a big difference. So yeah, we have clients with lots of, kind of bits of history in the past and, let's say, bumps along the road. But on adverse credit, the thing that would make us most nervous is if someone's kind of, very obviously walked away from a debt and kind of said, oh, well, I was in a company, it's not my liability, move on. All that sort of stuff makes us super nervous.
What if you do it again, basically? Pick up the pieces from you. So, I think that's an interesting point, because you can always talk something through, and as long as you've operated and behaved and with the best interest of getting the best result, even though things didn't go quite right, which they don't, then there are lenders out there that will look upon that favorably and look at the whole picture, and not just a piece of paper that says, you might have CCJs. Would Shawbrook Bank look at people with CCJs?
Yeah, from time to time. We prefer they're satisfied where we can, but we'll always spend the time to understand what happened and why. Ultimately, yeah,
it's all about that relationship and being able to understand and explain what's going on in the entire picture, rather than just because the difference, I think, between high street banks and some more challenger banks, more flexible ones, more commercially minded banks, is that they can take a view on certain things like that, whereas high street banks generally, from my experience, as soon as they see anything like that, they don't even want to hear the explanation.
Yeah, look, I think it just comes down to your business model ultimately. If you're trying to build this kind of enormous factory type business that just does, huge volume of units, then, I think it's quite reasonable to expect that in that sort of business model, you haven't got the capacity and the scope to deal with lots of kind of different individual bespoke scenarios that come up. It's a bit like if you went into an actual factory, the factory line will produce stuff that's the same time and time again. It doesn't produce stuff that looks a bit different every time it comes off the line. So that's that business model. Whereas the specialist lender business model is to say, well, look, there's other types of client out there. There's other parts of the market. Let's get the right people around the table. Let's get the experts in the room. And, these days, enormous support of technology as well to automate some of what we do as a lender, and come up with solutions for those people that don't fit the factory model.
Totally makes sense. And then similar question though, but because you generate a lot of your inquiries through the broker network. So in terms of brokers that are thinking about working with Shawbrook, or the ones that you enjoy working with the most, what sort of attributes do they have that make you have a great relationship and do lots of business with them?
Yeah, I think with brokers, you're obviously looking for people who are going to who know the market, have got a bit of knowledge around them. most of the brokers I find are very kind of client focused, very service driven, because one of the big bits of value a broker can add is just kind of getting stuff done, making stuff happen. Lots of our brokers previously worked at lenders. Not all, but I'd say there's quite a lot of brokers out there that have worked at a lender at some moment in time, and their kind of USP to the market is that they'll kind of understand it from the other side of the fence. They'll be able to articulate a deal in a way that a lender would understand, help to mitigate some of the risk before it lands on an underwriter's desk, which makes kind of the process getting to a yes a little bit easier. And the specialist finance market is big. There's hundreds of lenders out there of all different shapes and sizes. And actually, if you're an investor and a developer, it's very difficult to see the wood through the trees.
Yeah.
They're not all easy to find. Some don't market, some do. And brokers spend a lot of their time figuring out what that landscape looks like, so they can kind of shortcut an investor through to the right place, which has an enormous amount of value in a kind of bigger market.
And because I think that obviously I'm a broker myself, and it's always interesting to be able to understand what lenders are looking for in terms of criteria. I'll give you a good example of a frustrating thing, because of the process, how it works behind the curtain for borrowers, because I think that's somewhat of an enigma and somewhat of a frustration sometimes. I'll give you a really good example. I won't name any names, but we got some terms from a lender, and it was for a block of flats in sunny Blackpool, which some people may or may not know, that's not the most desirable place for lenders to go and lend, due to the kind of the demographic of the area, the income of the area, just generally, I think, percentage-wise, loan books or loans in those areas haven't performed very well. Yeah. So they've just been a little bit nervous, which we understand, which, as a experienced broker, we're very conscientious about that. So we kind of put it front line and center. It's the location of the property, for God's sake. It's the most important thing, I think, when you're looking at lending money. Is like, where's the security? Anyway, so we put the request out to gather some terms, and there was one particular lender that came back and said, right, we can do 75% against this block, income producing, great yield. It was all freshly done up. It's actually a very, very good asset. It's kind of got fronting the sea and everything, so it's actually a very, very good asset in our opinion anyway, and I think in most people's opinion. Anyway, regardless of all that, we're just expecting to hear back what they would lend. So they came back with 75% and then their pricing, etc. 3 weeks later, we were told that, we have to reduce the leverage from 75 to 65%. And the reason why we were giving was due to the location. We can't do 75% in Blackpool, which we were a bit like, well, that you should. Yeah. How come you don't know your own criteria? It's like, why did it have to go to credit for that decision to happen? Have you heard of those sorts of situations before, where lenders? I mean, for me, it's either the person, call it a BDM, doesn't really know their criteria, or sometimes it's a little bit more untoward, where they want to, because we told them, look, we need to get this done quickly. It's on a bridge. You need to get refinanced out. They just start the application thinking that by the time they get to the lower different terms, it's too late, and you're gonna have to accept it anyway. I mean, that would be really. But I've heard of those sorts of things happening. So when that sort of thing happens, do you hear a lot about that kind of like switching and baiting, or just incompetency to a certain extent?
Well, I think the latter scenario is very cynical. I think as a broker, if you have those experiences and your conclusion is that it is a cynical play to kind of get the deal in so that it's too late to kind of swap to a better product, then, it's short-sighted from the lender, because ultimately is that broker going to go back to that lender? Absolutely not, because it's just not the way to behave. I think the former, though, there's always a risk of human error. There's always a risk that someone will look at a deal and kind of just mispitch it or misquote it. One of the things we've tried to do is we've built something that we call the My Shawbrook portal. So we're trying to fuse the benefits of technology without losing the kind of magic of personal, expert human interaction. But what the portal allows us to do, which is the very initial stage of the deal before you even get your set of terms, is build in hard rules. So if there is a hard rule around, we don't lend in a certain postcode, or the LTV is capped out in a certain area, it's built into the portal to take the human error out of the process.
We like that.
So the conversations at the end are not, why have you moved the goalpost? The conversations of, oh, the portal only let me get to X. Why is that? And then brokers build their knowledge over time. But we've developed that. Yeah, it's worked really well for us. It speeds the process up. It creates better certainty of decision making. And what's really important for us is that when those terms go out, we stick to them at offer stage, which we've got a reputation is built on being able to do that. There'll always be deal-specific stuff that might happen. A valuation might come back in an area where you're very happy to lend 75%, but the valuer's commentary is just very negative or highlights some key risks. In that scenario, it's going to be a renegotiation of what that deal looks like inevitably. But where everything's as expected, it should just flow along. The terms shouldn't change at all.
Yeah, I agree. And yeah, we were fully expecting that it's subject to valuation, that things can change along the way, and legals, of course.
Yeah.
But on the face of it, there should be enough information there to make an informed decision to not at least change it that early in the process. Now, if I was to tell you it happened with the same lender twice in 2 months, with something slightly different, then you could kind of maybe appreciate the frustration on all sides. Yeah. Fortunately, a different borrower, because that would have been criminal. But we obviously have to go through that. What qualifications do you need to be able to do the kind of things that you do? Is it a history degree? Or
No. It's an interesting point, though. So if you want to go into regulated residential mortgages, you'll know this, Sam, from your own broker experience, you need CMAP, which is a technical qualification to be able to advise consumers on a regulated loan transaction. In commercial finance, you don't need anything. So there's no kind of professional qualification that's needed. You don't need to be degree educated. I've got lots of super successful colleagues that are not degree educated. What you need that kind of ability to immerse yourself into the market. I think a bit of commercial acumen and a keen interest in business helps. It helps understand what the client is trying to achieve and where they're trying to get to. It's a tough market. People need to be prepared to work hard. But it's a market full of, amazing opportunity. I've had such a great career, touch wood, plenty more years to go, because this market has just got those opportunities out there for people that kind of want to grapple it. So it's not about qualifications. It's about your own ability, your own effort levels, your own commitment to making it work.
That makes sense. And I think that, because, banking's changed since I was a kid. One of the guys I work with, his dad was a bank branch manager, which, back in the day, I remember my old man always used to talk about his bank branch manager and how great he was and what a great relationship he's got with him. And at one point, I can't remember, it was quite a few years ago, but he was like, "What's your relationship with your bank branch manager, Sam?" I was like, "I've never met him. I don't know who it is. I don't know anybody that really cares about who their bank branch manager is anymore these days."
No, I don't know. And to be fair, the model's just changed. The idea that you can go into a branch, speak to one person who kind of rules their kingdom, makes every decision for themselves is gone, isn't it? Like, we all know what happened in 2008, and there's more controls, there's more regulation. None of that is a barrier to anyone to borrow any money, but it just means the process is different, and therefore what you do to make that process a really good experience for people has to change over time.
And one of the questions I've been asked somebody else as well earlier was, in terms of the balance of opportunities, if you had an opportunity to have loads and loads and loads of money, but only a few borrowers, or the other way around, you got loads of borrowers that are all clamping over a small amount of money, which one would you prefer?
As a lender, you'd always rather have more money to lend, ultimately, right? You can do more. You can do more deals. You can make more things happen. I think when you're building a lending business, it's about balance on the book. It's really difficult to scale a business without doing some larger loans, if I'm really honest. Yeah. It's just really hard work because you so many units to do, and there's only so much time and so many people out there to do it. But I equally think there's risk in only doing bigger ticket deals, in that your exposure, if you like, to any one client or any one asset is proportionally quite big. So the ideal way of doing it really is to do a bit of both. You kind of have those clients out there that are doing individual smaller deals in volume with securities nicely spread out over the country, nicely spread out over different kinds of asset types. And that's the foundation that then gives you the kind of strength on that balance sheet to go and add some bigger, chunkier exposures in, because you can carry it, you can kind of wear it. So it's all about balance.
I find it quite stressful. I had a time in my career where I was a lender. It is very stressful. Even though it's other people's money, you're next on the line because they're not going to give you more money to be able to fund other deals, and that kind of short-lived makes your career or your business quite short-lived. And the famous saying is that it's easy to put the money out, but it's very difficult to get it back in. But obviously, you guys are doing an amazing job at Shawbrook Bank, and it's clear that you've got so much experience, and I think we'd like to have you back once the market does make its next few turns in the near future. But in the meantime, I'd like to thank you for joining us today, Daryl.
Thank you very much, Sam. It's been a pleasure.
Have a great day.
Cheers. Cool.
That's it.
Good. Nice one.
Cheers, mate.
Good questions as well. Some of them were tricky.